Kevin Cheshire here with Coburn Cheshire and Walker. Today we want to talk about tax on Social Security benefits. The one big beautiful bill that was signed in July of 2025 made a change in this area that's going to benefit many people. So the key change is what is known as a senior deduction. It is a $6,000 additional standard deduction for taxpayers who are 65 or over at the end of the year. Married couples get double that amount, $6,000 each. This helps reduce your taxable income, so it does benefit you, but it does not directly eliminate tax on Social Security. The rules about tax on Social Security haven't changed, and I'm going to cover those briefly in a moment. So who qualifies? Well, first of all, you have to be 65 or over. Married taxpayers must file jointly. If you file separately and you're married, you do not get this benefit. And you must have a valid Social Security number. There are income limits and phase-outs within those limits. If you're married and filing jointly, up to $150,000 of income, you get the full benefit. Between $150,000 and $250,000, the benefit phases out, so you get a partial benefit in that range. Above $250,000, you get zero. If you're single or head of a household filer, same concept applies. The limits are just $75,000 to $175,000. Modified adjusted gross income includes things like wages and salaries, interest and dividends, and most other income. It's typically your total income. And many of my clients believe that their Social Security benefits are not taxable. Well, that's just not true for many people. It's a common misconception. Social Security is not fully tax exempt. Many retirees still pay federal income tax on their benefits. Matter of fact, many pay tax on up to 85% of their benefits. That's the maximum amount that can be taxed. And the amount of your Social Security that is taxable, it depends on your income threshold. There's a concept called combined income. To calculate this, you take your adjusted gross income, think total income, plus non-taxable interest, and add to that 50% of your Social Security benefits. If that combined income is greater than $32,000, and you're married filing jointly, then your Social Security is going to be partially taxable. If you're below that $32,000 threshold, zero of your Social Security is taxable. Now, if you're single, the threshold is $25,000. So above that line, you start paying tax on your Social Security benefits. Hopefully this has been helpful. It's high level, I realize that, and it's not necessarily going to work in your specific situation. This is just general in nature. So I hope you have a wonderful day, and feel free to share this, like it, follow us on social media.